Credit card balances are one of the most visible elements of a credit report because they represent the current amounts owed on revolving accounts. The topic of this lesson, how credit card balances affect your credit profile, focuses on understanding how these balances contribute to the overall financial picture lenders review when evaluating creditworthiness. Credit cards operate differently from installment loans because they allow borrowers to repeatedly borrow and repay funds within a predetermined credit limit. Each month, the card issuer reports the account balance and payment activity to the credit bureaus. These updates become part of the trade line associated with the account, gradually building a timeline of how the card has been used. Because balances can change from month to month, they provide lenders with insight into how the borrower manages revolving credit over time. When lenders examine credit card balances, they often consider how those balances compare to the credit limits attached to each account. This comparison reveals credit utilization, which helps lenders understand how much of the available credit is currently being used. A card with a relatively low balance compared to its limit may signal that the borrower is maintaining financial flexibility. A card with a balance that approaches the credit limit may indicate that the borrower is relying heavily on that account. However, balances are not evaluated in isolation. Lenders typically review patterns across multiple accounts to understand broader credit behavior. For example, a borrower may carry balances on several cards while still maintaining overall utilization that appears moderate relative to the combined credit limits. In other situations, a borrower may have only one or two cards, but carry balances close to the limits on those accounts. These different patterns can create different interpretations, even if the total dollar amount of debt appears similar. Another important factor influencing how balances appear on credit reports is the reporting cycle used by credit card issuers. Most card issuers report the balance that exists when the monthly billing statement closes rather than the balance that exists on the day the report is reviewed. Because of this reporting structure, a card may show a balance on the credit report even if the consumer pays the account in full each month. The reported balance simply reflects the amount owed at the time the statement was generated. Understanding this process helps explain why balances sometimes appear higher on the credit report than the amount currently owed. Lenders reviewing credit reports are generally familiar with this reporting cycle, so they interpret balances within the broader context of payment history and utilization patterns. Payment history remains one of the most important indicators associated with credit card accounts. When payments are consistently made on time, the account gradually builds a record of reliability. Even if balances fluctuate from month to month, consistent payment behavior often signals responsible credit management. Conversely, missed payments can quickly change how lenders interpret the account because they suggest that obligations were not met according to the agreement. The relationship between balances and payment history therefore plays a significant role in shaping the credit profile. Another aspect lenders consider is how balances change over time. A credit card balance that occasionally rises and falls within reasonable limits may indicate normal spending patterns. However, a balance that steadily increases without corresponding payments may signal financial stress. Lenders examining the report often look for these trends across multiple reporting periods to understand whether balances are being managed effectively. Within the credit strategy framework, analyzing credit card balances helps consumers interpret how revolving accounts contribute to the overall credit profile. Instead of reacting to balances as isolated numbers, individuals can observe how those balances interact with credit limits, payment history, and the timeline of account activity recorded in the report. This analytical perspective reveals that balances represent more than just amounts owed. They serve as indicators of how credit's being used and how consistently obligations are being handled. By studying these patterns, consumers gain insight into how lenders interpret credit card activity when reviewing applications for new credit. Understanding this relationship encourages a more informed approach to reading credit reports because it highlights how each account contributes to the broader financial narrative recorded in the credit profile.